ผมขออนุญาตนำเข้าสู่ช่วงต่อไปเลยนะครับก็คือ navigating global uncertainties opportunities amidst challenging times นะครับซึ่งจะได้ฟังมุมมองจากผู้เชี่ยวชาญระดับโลกเกี่ยวกับการรับมือกับความไม่แน่นอนทางเศรษฐกิจและโอกาสการลงทุนที่ยังคงอยู่ในสภาพแวดล้อมที่ท้าทายนะครับช่วงนี้ผมดำเนินรายการเองนะครับขออนุญาตเรียนเชิญ I'd like to invite my panelists on the stage คุณฟูเจียลิวSenior Equity Product Strategist from eFund Management Company Limited. Mr. Alistair McDonald, Investment Strategist from Wellington Management. And last but not least, Christopher Wong, Client Portfolio Strategist, Southeast Asia, Fidelity International. Good morning and welcome to Thailand.
Hi.
No jet lag? No, right? No jet lag. So, well, navigating global uncertainties. In short, managing Trump. Right? So, we will be discussing navigating global uncertainties, opportunities amidst challenging times. I'd like to begin with Fujia. You will be giving us the outlook on China, right? So let's begin with China.
Hi, good morning to you all. My name is Fujia Liu from eFund Management. We are China's largest comprehensive asset manager with 400 billion USD under our management. So glad to be here. I was here last year as well, so I saw many familiar faces. So starting with the China macro update, I think last panel there was some discussion about that already. But in our view, we think that China has been showing case a very resilient growth and stabilization at this stage. If you think about the first half of 2025, actually our GDP has exceeded expectation. And looking into the breakdown, if you look at the consumption level, I know many people were worried about weakness in the consumer behaviors. However, the latest retail growth number is 5%, which is higher than the median level last year. So you have seen the recovery on the consumption side. And manufacturing continue to be very strong. And that is the economic transformation journey from the low end to high end, or what we call the high quality growth productivity drivers. And in addition, I also want to mention that, if you think about the external risk, which was the most heated topics at the beginning of the year, actually the US-China tariff tensions has been easing following the Geneva talks, London meeting, as well as the upcoming Sweden meeting, just in a couple of days. So we think that the worst case scenarios has been mitigated, and China's policy support from September 2024 has been giving what we call the policy put for the general macro backdrop. What does that mean? That means that, with the macro front, we think that will translate into the equity upside. That is why I think many of you as investors have already witnessed the strong rally in China market year to date, both in A-share and H-share. And there are a lot of thematic investment opportunities I will highlight later on, which I think everyone should be looking out for. Thank you.
All right, so that's round one for Fujia. Let's move now to US and perhaps EU as well, but let's start with the US. Are we hopeful or are we pessimistic or optimistic about the US market?
Great, thank you. Wonderful to be here. This is probably my 40th or 50th time that I've had the pleasure of visiting Thailand. Bangkok is wonderful, Thailand is wonderful, so thank you very much to our partners here for having us and for everyone joining us. Now, just to make sure that everybody is listening, I always love to start any presentation with a big picture of the man himself, Donald Trump. I'm sorry if you've just eaten, or even worse, if you're currently eating, but you can see Trump here. He's brandishing his book, Trump and the Art of the Deal. Now, To understand what's happening in markets and the world, geopolitics this year, rather than reading the fake news, you should read his book. Because what he's achieving is actually quite remarkable. You see, at the start, when he came to power, start of this year, tariffs, if you looked at the worst case scenario, it was maybe 10 to 15%. Now, that's celebrated as the best case scenario. And markets are up. US markets are up nearly 30% from their lows. And countries, allies such as the UK and Japan, are actually celebrating a tariff deal of 10% or 15%. They're celebrating that as a win, even though they're the ones paying the tariffs. And so the fake news, as Trump would call it, may not give you the best impression of what Trump is up to, but actually Trump has been doing a lot of winning. And so if we run through a few of these areas, so first of all, you've had these tariffs introduced and trade deals being announced, but tariff revenue is expected to reach around $300 billion this year. That's massive. It's about 5% of federal revenues. Second of all, tariffs are already working. You heard earlier discussion with regards to the reshoring and manufacturing investments taking place in the US. These amount, by Trump's count, to about $2 trillion. Now, maybe Trump is exaggerating, but it's still a lot of investments. Third of all, you're seeing digital services taxes that had been placed on US tech companies being removed. You're also seeing various other non-trade barriers being removed, all of which is to the benefit of US companies. And finally, fourth, the wonderfully named Big Beautiful Bill has gone through, and actually that provides more positives for these companies than tariffs. The benefits outweigh the costs of tariffs. So in Trump's words, he is doing so much winning. Now, moving on from the geopolitics, we have to remember that we are investing in companies. You're not investing in the US or China or Europe, you're investing in US companies. Now, the critical aspect in the US that drives success of the economy, success of markets, is innovation. And US companies are not only innovative, they're uniquely able to translate innovation into earnings. And that's exactly what you're seeing. And so what we're showing here on this slide are the companies founded in the last 50 years, large cap companies. The green circles are tech stocks, the blue circles are non-tech stocks. You're showing the US versus the EU. The takeaway is pretty clear. The US is incredibly innovative. Now, this doesn't include older companies or joint venture companies, so a stock such as ASML is not included, but if it was, I'm not sure if you can read it, but Tesla is the big blue circle on the right. Salesforce is next to it. That's about the size of ASML. The largest stock in China is Tencent. Next to Salesforce is Oracle, one of the mid-sized green circles. That's about the size of Tencent. Chinese companies are tiny compared to US companies. The US has been uniquely able to generate success. Another key aspect, the rule of law. A lot of fake news articles on Trump and the rule of law. Many of you will have followed Elon Musk and Donald Trump, their amazing bromance, which ended up in a heartbreaking breakup. But what happened to Trump? Sorry, what happened to Musk? Is Musk in jail? Did Musk disappear? No. What happened to Tesla? It's still a $1 trillion company. Now, by contrast, if we look in China, what happened when Jack Ma criticized the financial system? He disappeared for a few months, and the share price of Alibaba has never recovered. And so the takeaway really is the exceptionalism of the US is driven by companies, innovation, and the rule of law. And just the final point I would like to make is, what was Donald Trump's mandate? What was he elected on the basis of? To make America great again.
So, Team Trump.
That's right. I love wearing this cap.
Well, draw the attention to your socks as well, so you're still Still UK, which will move to the UK and the EU as well, but that will be the second round, Alistair. So let's now hear from Chris as well. Do you agree or disagree with the way Trump is actually maneuvering the economy with all this, fake news and false information, but in fact, it seems to be going well?
Yeah. Sorry, everyone. Thanks for having us. That's a really tough act to follow. I'm going to agree and disagree with some part of what Alistair said. So yes, there are many quality companies in the US that are highly innovative. The only thing we have and are a bit more concerned is valuations, right? And then the role of the US going forward. And that has an impact on what we tend to say equity risk premium or subsequently multiples. So at this point in time, I think there's a lot of policy flip-flop. There's a lot of policy uncertainty, right? So you're seeing geopolitics everywhere. In the US, you're seeing this policy, this tariff flip-flop, right? Whether it's 10%, 15%, 25%, is it August, is it further down? It's very uncertain, right? And how do you plan as a CFO or COO in an environment like that, right? You just delay, and it's showing up in capex intentions, etc. So with that, I think the trust in US, especially now, you're not only doing it to so-called economic foes, you are doing it to allies, right? So the trust generally in the US is a little bit shaky. So then again, what role will US play in your portfolios? What role would it play in markets? And I think bond markets, US dollars are starting to make their votes, and they are kind of testing this thesis that the US is exceptional. I think that's being tested a little bit. So for us, at this point in time, US looks expensive from a valuation perspective, if you could bring up my chart. But anyway, US trades 50% more than the rest of the world at a point when the economy is slowing. Soft data points to a slowing outlook going forward. On the corporate level, your US earnings is starting to roll over back to where the rest of the world is, holding up a lot more stable and catching up. And then US has been, I think mentioned in the previous panel as well, a significant part of markets, right? So if you look across equity indices, it's about 64 to 70, 80%, versus your long-term averages of closer to 52%. So if you follow my train of thought where policy is uncertain, growth is slowing, valuations rich, earnings slowing in the US is a huge part of markets with room to kind of be a bit smaller than it is now. I think there is really room to look outside of the US to really get your exposures.
Mm-hmm. And apart from China, where else should we look for it then?
In fact, where we like now are China, Asia, Europe, and maybe I'll just bring across Europe a little bit, because I think there's a general misconception amongst the investment community that Europe is a slow-growing, structurally challenged economy. That is true, but you have to differentiate between economy and company fundamentals, right? So the economy or your GDP number only explains the demand side. It doesn't explain the supply side, which companies have control of, right? So when you look from that perspective, there are many global companies, let me reverse this. There is a low to no correlation between economic growth in Europe and the outlook of earnings for European companies. That's one point I will make. Two is if you look in Europe, there are many global companies there. Bearing, yes, there are no Magnificent Sevens there. There are no Teslas, there are no Nvidias, but there are many sectorial leaders that are in Europe that are very much leading the pack and best at what they do. So for us, it's really looking outside. Asia, China, Europe brings about good opportunities, and you're not overpaying for it.
Yeah. So for the continuation of the thought's sake, let's continue with the Europe then. What's your take on EU?
Sure. So I think the perspective from Asia, when you look at Europe, it's often seen as a holiday destination or maybe a shopping destination to buy that watch you're waitlisted for or the bag your wife would like. So expensive and not necessarily a place for investing. Now, the actual performance of European equities has been extremely strong year to date. The European markets are up close to 30% in US dollar terms. It's been an exceptional time, maybe 25%, I'm probably exaggerating, but it's been a very, very exciting time for Europe. Now, there are a couple of reasons behind it, but one of the major reasons is a backdrop of significantly higher spending globally. Now, we mentioned in the case of the US, Trump's big, beautiful bill and the spending there, but you're also seeing a lot of spending in Europe. And so economies have reacted very decisively to combat a tariff impact. And actually, so far, there really hasn't been much of a tariff impact. So you've got a big stimulus announced to combat a negative that hasn't really transpired, hasn't really impacted the economy. Now, this is most evident in Germany. Now, you may have noticed my surname is MacDonald. It's a Scottish name. And so for those of you who have traveled in the UK, you may realize that Scottish people hate spending money. We're known as being very tight, not spending money. But actually, Germans are even worse. Germans never spend money. They really, really hate spending money. So what you're seeing with this German stimulus is culturally actually quite incredible. And the impact on the economy, both of Germany and the broader Eurozone, is going to be significantly greater than the impact of tariffs. But you're also seeing stimulus in Japan, stimulus in the UK. It's really a broad-based narrative. And what this translates into, to build on some of Chris's points, opportunities in Europe, in domestic-orientated stocks in particular. And so think of European banks. Right? These are not the big, sexy, exciting tech companies you get in the US. They aren't the amazing, innovative AI companies you get in China. European banks are pretty boring. But actually, the returns have been amazing. You've seen a complete cleanup of non-performing loans. They've consolidated their competitive backdrop. They're growing, and they're giving big share buybacks and dividends and distributions to shareholders. The European defense sector is another one where you've got a multi-year trend. The stock Rheinmetall, when we bought it a couple of years ago, no one had heard of this German tank manufacturer. In the last 5 years, its performance has roughly been on par with NVIDIA. That's how amazing the performance of European defense names have been. European cement companies, again, a really boring sector, but actually one where you've seen amazing growth, amazing return on equity, amazing profits, because you've got big stimulus and you've also got carbon adjustment mechanisms that prevent cement imports from cheaper countries such as Turkey. So really we see a lot of opportunities in Europe. But I still have to talk about tariffs, because Europe is a very international and trade-orientated economy. And so this is a bit of a complicated slide, so let me explain it. So if you look at the MSCI Europe as a whole, roughly 25% of revenues come from the United States. Now, of that, the majority of those revenues come from services. And so looking at this chart, we're breaking down foreign exposure by sector for the MSCI Europe. And so, for example, if you look at the right-hand side, you can see the light orange. Those are services companies. So, for example, we own Allianz. We'll have our friends presenting from Allianz later. The flow to Allianz owns PIMCO. The flows going into PIMCO's fixed income funds are not subject to tariffs. So we love that company, no tariff impact. Then you have the orange, the darker orange bars. These are companies manufacturing in the US for the US market. For example, we like Siemens Energy, which is producing gas turbines used to power the AI boom in the United States. And then finally, you have about 6% of revenues for MSCI Europe as a whole coming from direct goods exports from Europe to the US. It's a small amount. We don't think it's actually that important. And the kind of companies in which we're invested aren't heavily exposed to it. Yes, you may have noticed defense names are actually heavily exposed to exports in the US, but the defense names we hold are much more focused on European demand, which is a much more positive story. So even with tariffs, even with companies based in Europe, there's a huge amount of opportunities, both domestic orientated and those with foreign exposure.
China, opportunities in China. Are there still any promising opportunities in China given the state of the economy that it's facing at the moment?
Certainly, there are many. Before I elaborate on the long-term investment opportunities we are constructive about, I'd like to point out a few short-term catalysts, because actually many investors ask me about the recent rally, and also the sentiment has been really high in China. So a couple of points. Obviously, I mentioned about the macro backdrop earlier. In addition to that, there are policy like a trade-in program, which stimulates the domestic demand on the consumer electronics, home appliances, and that is why in some of the consumer sectors you have seen the really green shoots. But in addition, I think what's really been discussed lately is the anti-involution policy. For investors that haven't heard about it, it's somewhat similar to supply-side reform back in 2017. Basically, the anti-involution policy is targeting sectors like steel sector, coal sector, renewable energy, EV sector, which is, to global investors kind of oversupplied or redundant capacity kind of sectors. So really this guidance to the, the reform is to cut the, cutthroat price war, price competition, especially in the EV and renewable sector, and then promote quality over quantity. And this is really something, I think, not only just one-off catalyst, but it again shows the continuity of Chinese government to steer the economy to the high growth productivity development. So, and if you look at the beneficiary sectors under this policy, it's around renewable energy, EV, as I mentioned, and also pro-cyclical sectors, which were very low valued, and then really overlooked by the investors, and now also catching up in the rally. So that's for the short term. But for the long term, there are many investment opportunities in terms of the themes I would like to highlight. I think some of them, already mentioned by our panelists here. Maybe I will start with the AI first, which the chart that Alistair shows earlier, very impressive. I think AI, after February, everybody knows the DeepSeek moment. DeepSeek really disrupted the AI global landscape by providing the open source model and also achieving high quality or high performance only at a fraction of Western models' cost. That means it's democratizing the whole AI industry and really provide AI for everyone at very cheap cost. In China, as a result, you have seen really the prosperity across the whole value chain, from upstream like materials, AI infrastructure, to the cloud services, mentioned like Tencent, Alibaba, ByteDance being the internet giants to lead that area, and also to semiconductor. China is also manufacturing and producing their domestic substitute GPU chips and CPU chip, etc., and to the downstream AI applications in the format of iPhones. AI phones in general, and also intelligent driving, many terminals for the users to apply AI. Back in 2015, if everybody remember, in the internet stage, China emerged as the global leader in the AI application, in the application perspective. And that is when Tencent, Alibaba, ByteDance emerged during that time. So at this round, we think we will follow the same trajectory. So AI infrastructure being the leaders in PCB, in optical communication. Actually, in PCB industry, we generate 40% of the total output value in the total global market share. So China, given the cost and scale advantage, as well as the engineered dividend, we continue to be the market leader in the infrastructure and the manufacturer space in AI industry. So that's, the area I think everybody should look out for when investing in China, being in the whole value chain. But in addition, I mentioned about high-end manufacturing, so EV as well as renewable energy, we are already the global leaders. So just to quote in the numbers, 2024, we sold 11 million units of EV, and that's more than 50% of the global market share already. And I'm sure, people here in Thailand can see many BYD and other, domestic car makers brand in Thailand and in many of other countries as well, because these EV manufacturers are going global and gaining market share aggressively. Similarly, if you look at what's on the ground in China happening right now, I think innovative drug is something really compelling at the moment. For investors who have invested in this area, maybe you have already get 100% return year to date. That's how crazy this segment is in the innovative drug. What happened is the pharmaceutical companies or biotech companies are also transforming from the traditional manufacturer or R&D center to be the biotech innovators, especially in the format of licensing out deals with the global MNC or global farmers. So as a result, if you look at the current global market share of the BD transaction value, Chinese biotech companies account for 55% of the global market share already in 2025. And that's not just, a one-off kind of rally. It's accumulation of our cost advantage again, as well as our rapid clinical, execution capability. And that is why I think the global MNCs, they are kind of in the formal attitude and working with a lot of Chinese biotechs on this front to going global. So these are all the highlights I think the investors should look out for. Despite the general macro backdrop, we think there are many, tremendous growth opportunities in China happening right now, and there are a long way to go to catch up that rally.
So how do these investments or opportunities immune to what's going on in geopolitics? I mean, will they be affecting any of these opportunities at all? Because the reciprocal tariff that you mentioned, Geneva or Sweden, it's not final yet. How will it play out?
You're right. So I think obviously, when we forecast our GDP forecast as well as, the upside return, we already factor in 40% of tariff, which is higher than the current, situation right now. So, at the beginning of the year, everyone already priced in the worst case scenario. And what I mentioned earlier is that the ongoing negotiation actually exceeded the expectation. So I think at this moment, of course, we're still waiting for the Sweden talk to happen, but, they are, in general, generally speaking, already the worst case price in. And if you look at the export growth, it continued to deliver the much higher than expected growth, being 5.8% at the latest number. And companies are going global, building up the factories and capacities in the global plants, so to mitigate the onshore risk from the tariff situation.
Mm-hmm. Alistair, you brought the MAGA cap, the Make America Great Again, but we also heard TACO. Trump always chicken out. So will there be any accidents down the road, with his policy or the way he's driving the world economy with this reciprocal tariff?
Yeah, very fair question. So yes, MAGA versus TACO. I think there was a quote recently, I think it was Scott Bessent, and he said that Trump has an uncanny survival instinct. And so he was applying that to markets. and indeed to deal making more generally, right? Trump will keep pushing, but a point at which if the markets really are collapsing, if there really is pushback, he will then give some ground. And so I think we've seen that in his first term and indeed thus far in his second term, that he has had an ability to read the geopolitical room, to read the markets and understand when to push and when not to push. And whilst the media in general hates Trump, and so it's very hard to read anything that's positive, if we look back on his first term, it was actually an amazing time for markets. It was an amazing time for US markets, and actually, ironically, perhaps it was actually a very good time for Chinese markets as well. And so, I think this does come back to the point. I mean, we're up here to compete with each other a little bit, but, it's not a winner-takes-all environment. And we would agree with some of Chris's comments that the world is deglobalizing. And with that comes additional benefits from global diversification. And so, having too much in just one country, or whether that be the US, whether that be China, is more risky, we think, in the current environment. It does make sense to invest in companies based in Europe, in Japan, where you have very different economic backdrops. You have different cycles, greater divergence globally. We haven't spoken about Japan much, but that's an example of a country which has a very, very different cycle versus the rest of the world, where it's been trying to boost inflation rather than reduce inflation, where you've seen amazing corporate governance reforms, where you have world-class exporting companies dominating various fields of AI. Indeed, I've presented on that subject in previous events here. But you also have some amazing domestic stories, whether those be financials benefiting from a rising rate environment, whether it is companies aiding Japan's digitalization efforts. And so I think that the backdrop is that whilst we spend a lot of time talking about Trump geopolitics, the takeaway is almost always the same for investors. Focus on the companies and make sure that you're diversified. There's a lot of opportunities.
Have we missed out on any markets apart from US, China, and what about India or any other countries in the Southeast Asian region? Are there any prospects? Chris?
Yeah, that's a good question, right? So for us, I think, again, I will go back to the overarching message, look global, look beyond the US. It is, and this is the chart I wanted to allude to a bit earlier. So this represents equity, and the blue represents how much US is over a course of about 25 years. And right now it stands at 64%. But if I were to draw a line through a cycle, let's call it 25 years here, it is much closer to 50%, right? So valuations rolling over, earnings slowing, trust is a bit shaken. It can probably be a smaller part of global markets, and the opportunity set is everywhere, right? If you looked at Europe, valuations are about cycle average, 15 times forward, give or take, versus US, you're looking about 21, 22 times. China, easily way cheaper, and earnings growth actually accelerating through this challenging period. So China's one area we like. Europe is one area we like. India, we also like the long-term outlook. Valuations are keeping us a little bit more careful there. In Southeast Asia, it's coming back to the fore as well, right? So you start to see Singapore start to do a little bit better because of its more defensive income nature. So Singapore's an area we're also liking. So broadly, and Latin America, not something that we speak a lot about, but it's benefiting a lot from the global commodity boom, led a lot by EV, by AI, by precious metals, etc. So, and then it is, a lot of mining companies tend to sit in Latin America. So if you look at this year's returns, they have not done too dissimilar from where China is. So I think the opportunity is everywhere. Focus on fundamentals, focus on valuations and where earnings are.
I think for the last round, we have 4 minutes left. I will focus on the challenges or the unexpected, factors that might affect these beautiful prospects that you've been sharing. Starting from Liu Jie, maybe. Any unforeseen challenges that we should be aware of?
Yes, so obviously we are still in the middle of the tariff negotiations,
Yes.
not only just, speaking of China or, to other countries for transshipment countries as well as Europe. So that all change the dynamics of how China will react as well as how the economy is bringing forward. In addition, I think obviously we are still under the economic transformation as I mentioned. So property sector, consumption sector is something we are still keeping watchful about the recovery or the gradual recovery. But that being said, the last message I want to deliver is when you think about China with 1.4 billion population and also rising savings pool of pocket of 150 trillion RMB at the moment, that means the sufficient liquidity as well as the injection power for the equity market in general. So I think, once we are coming out of the economic trough and the current cycle, there are huge upside considering, mentioned earlier, the low valuation and also the sufficient capital in place. And again, with the growth, pro-growth policies in place, we think generally speaking, there are many areas to invest into in the bright future.
Alistair, you talk about the defense sector and also the cement sector. So, judging from that, it doesn't seem like the war will be ending soon, right? So, because that's fueling the defense sector.
Right. So, just to be very clear, I think everyone in this room, everywhere, would want the Ukraine-Russia war to end tomorrow. And I think we are investing on the hope that does happen, right? This isn't an investment predicated on the war continuing. It's an investment in defense because the world has changed, right? The US is reducing its protection for Europe, and regardless of whether there's peace in Ukraine, Europe needs to rearm. And so it's driven much more by that 3.5% NATO target than the specific war in Ukraine. But more generally, what I think that the biggest risk is, and I think at Wellington as a whole, this would be the biggest risk across many strategies, is actually inflation. We don't think inflation has been beaten. If you look globally, you have massive spending, big debt problems, and it's not just limited to the West. Whether it's Japan, elsewhere in Asia, Europe, the US, there's a lot of spending, big deficits. Inflation remains above target. Unemployment is still around lows of the last 50 years, and yet central banks are cutting rates. The UK is actually the best example of where the central bank and the government are really, they just can't wait to start cutting rates. But actually nominal GDP growth is very high, and inflation across the West has been above target for nearly half a decade. And so we think the bigger risk is maybe in a year's time, maybe a little longer, inflation starts to tick up again, and suddenly the market starts to think about rate increases instead of rate cuts. And we think that's something markets are not currently priced for.
Chris?
No, I think that was a great points, and I agree. So the biggest risk right now is if we face a slowdown in growth. That's one part of it, right? Given things are already slowing, uncertainty is rising, that could bring growth down significantly, one part, at a time when inflation stays high, right? And then monetary policy then cannot come to aid because they have to manage inflation as well as a central bank. So that could be the biggest risk. But then again, there doesn't mean there are no opportunities, right? So in an environment like that, focus again on diversifying, focus on quality. So and income in your portfolios, that helps to reinforce your portfolios. It is also focusing on fundamentals, right? Which company are you buying into? Where they sit in the value chain? How much pricing power do they have? Where do they produce their goods? How much cost can they shift on, etc., right? And in an environment like that, these companies can very well survive a lot better, pass on their cost to their customers, protect their margins. So it will come down to bottom-up stock selection, case by case, in an environment as such.
Thank you very much. The clock is ticking. My time is up. So thank you once again, Chris, Alistair, and Fujia, for your wonderful insights into the opportunities and the prospects of investment. Thank you so much. ขอบคุณมากครับ
Thank you.